If you're totally rational in life, you might not make it as a founder. You need just a little sprinkle of delusion to make it as a founder. Sometimes brilliant people are focusing on suboptimal problems to solve. You wear many hats as an investor. Two roles that have come to the fore in the last 2 years is the role of a co-operator and the role of a therapist. Just in extension of that, it's not just one person therapy, sometimes it's two. Because when things are not going very well, tension rises between co-founders, right? And you need that team to stay together because they have complementary skills. And so what happens is sometimes you have to call people in the room and say, hey, what's going on? Just like those rooms, say, so how does that make you feel? Say, oh, he did this and he did that and he did that and did that. So how does that make you feel? Okay, tell him sorry. No, this shit actually happens. And everybody knows that investors are wrong most of the time. Great investors need to just be right more often than the rest.
Welcome back to the podcast. This is your second time. You're the second time guest I'm having, if I'm not mistaken. Yes. You can add...
You hear of many firsts.
Yeah, so welcome back.
Thanks a lot. Appreciate it.
Thank you. So let's see. Last time we had like a venture capital masterclass, and I recently discovered that you failed maths in secondary school. So I want to know.
I blame my team for letting this out. It was supposed to be in-house.
Well, thanks to them, because I can relate. I practically failed second maths almost throughout secondary school.
Olodos unite.
Yes, thank you for that. But I can blame it on my teacher. He made maths terrible.
I agree. I think the educational system is part of it.
Yeah.
I only found out that I had like attention deficiency in my adult life, and I discovered I learned better from like watching and listening than reading.
Okay.
So I can blame my math failure on that.
In my own case, the man threatened me he actually threatened my life for asking a question and threatened to drown me. Every time I think about that story, man traumatized me. He said if I wanted to get an answer to the question, I should tie a millstone around my neck and jump into the river. So there was a river close to our school, and that was the last time I ever passed maths in my life. I barely scaled through when I was writing WAEC and NECO, or else, I don't know.
At least you have your excuse there.
Yes.
Failing is better than drowning.
I mean, because I thought about that for a few days and just decided maybe this isn't for me. But
you're like, you know what, I'm going to fail.
But how did you go from that, struggling with math, to now working in jobs where you kind of require skills that you would have learned in math class?
So I think just human psychology is a very funny and unique thing, right? Your brain and your senses react to the same thing differently based on your motive, right? I just think, and this is just in life, right? If you haven't found your why, things might seem a little more difficult than it should, right? And that's just because you might not have the right motivation to put in the work. And I think that was it for me. I just couldn't understand why I was doing this, right? I would consider myself more arty than actually scientific.
Okay.
But I would think I'm balanced, right and left-brained, right? My dad is a veterinary surgeon. My mom used to sing orchestra. She's left-handed. So you can imagine if I fail at venture capital, I can become an actor or a podcaster. So I'm covered all around. But it was difficult to really engage that part of my energy, right? Because I didn't have a strong why. I just knew you were in school, you had to do this. The things that came to me naturally, I would do. The things I needed to really apply myself for, I wouldn't be as good. And I told you, I have ADHD, and it does show up in many different ways, not being able to follow trends. And math, the way it's taught in Nigeria especially, it's steps,
Yes.
right? You follow steps, and everyone else is learning in the class, and you're there. You follow step 1, step 2, and step 3. You just find out that you're chewing your pen.
And sometimes the steps are all over the
Correct.
blackboard. Yeah.
Or you just discover you're looking outside and wondering when is lunch, and F, right? So that happened for a while, but I think it took a very serious conversation from one of my cousins, Ohi, who said, and this was when I was getting to SS3, she said, if you fail math, it's not just going to be math. You're not going to get into school.
True.
Girls are not going to like you anymore. And your life is over. And I think it was the why moment for me. I said, so this thing's actually going to affect the progress of my life, right? And so I took it a lot more seriously, found ways around it, and I did decently well. And I think I shamed my detractors. So yeah, it does happen. I think finding your why is just the most important thing. Yeah. And now I'm in a place where I calculate valuation caps, stakes, percentages, how much I need to put to get a particular stake. I calculate dilution 2-3 rounds out without even using a pen or a paper. I guess it's the why. Yeah. Right? I found my why.
Interesting story. I guess for the rest of us, you need to go find our why for that. Well, I think I like that story because in my own case, yes, I knew if I didn't pass my house, there was no school for me, which was, if you grew up in my house, that was a dreadful...
And Nigeria, school is the only way out.
Yeah, I mean, so that's the only option. It was either school, or my dad used to say, it's either school or you failure. Like,
disgrace to the family.
Disgrace to the family. And I'm the first one, so you can't be the disgrace.
Don't try it.
So, yeah, thanks for sharing that. So, you've made quite a number of investments in the last couple of years. What are some insights you've learned about investing in Africa?
It's very different. First of all, I think people who invest in emerging markets like Africa or developing parts of Latin America, Caribbean, I think we're actually the most skilled investors, right? Mm-hmm. It's like being a skilled sailor, right? You're fighting government regulations, you're fighting FX risk, you're fighting multiple sovereign risks, right? Because your area is big, unlike people who invest on the East Coast, right? And so you're fighting multiple things you don't even know until you come out victorious. And so I think investing in Africa is different. It is very, very, very different. I actually feel that most of the people who are investing in Africa and are succeeding at it are probably some of the best investors in the world, period. Mm-hmm. Things change a lot, but what happens is that there's this Africa fiber. Even though we are sometimes many different countries, there's this Africa fiber that pulls the market together. It's not a financial cord, it's a cord of togetherness, and that also does help. But I would say, yeah, they're just a lot of moving parts.
Mm. Okay. So in the last 2 years, I'm sure a lot has changed for you as an investor.
It's always changing. Always changing.
Yeah, it's always changing. But I mean, it's probably gotten a lot harder in the last 2 years. You're having your portfolio companies probably struggle, and now they're, like you mentioned, they're battling a whole lot of forces: evil forces, spiritual forces, physical forces, and then on your own end, you're struggling to also like convince more LPs to invest in you. How has your role changed in that period?
So you wear many hats as an investor.
Okay.
I think two roles that have come to the fore in the last 2 years is the role of a co-operator and the role of a therapist. Right? You think I'm playing?
No, I mean, I can relate with that of a therapist, I can imagine.
Yeah, I still had a founder breakdown on me on the phone yesterday. You know, she was talking all strategy. Next thing I just heard, I'm just tired. And this is your everyday life. Don't forget, you have to be your own therapist too. Right? And so a lot of what you have to do, especially as an early investor, is to just get people to keep going. right? I kept going because the time where I went out to raise my first fund was also a difficult time, right? If you weren't, if you were just African, right? It was a difficult time. And so you've passed through that. And then you're here, you see people going through what you probably went through, where it just looks like, am I going to break through? Right? So you do have to spend a lot of time just telling people, you can't do it. You can't do it. There's light at the end of the tunnel. You're doing better than most people, right? You have 2 months runway. I just got off someone that has. Have you ever heard of minus runway? It's like when they come to you, I'm owing 2 months salaries, right? So it's those two roles where sometimes you literally have to step in to help, right? What can I help you with? What can I help you? What's your most pressing challenge? Oh, I'm looking for a CTO, and all of a sudden you become a headhunter, right? Because they need that to do their job. But as I said, the other one is therapist, and just in extension of that, it's not just one person therapy. Sometimes it's two, because when things are not going very well, tension rises between co-founders, right? And you need that team to stay together because they have complementary skills. And so what happens is sometimes you have to call people in the room and say, hey, what's going on? Just like those rooms, say, so how does that make you feel? Say, oh, he did this and he did that and he did that and did that. So how does that make you feel? Okay, tell him sorry. No, this shit actually happens. And so, yeah, and so those are the two rules that rise in the winter. But if you can get through it, the rewards are rewarding.
So being a therapist, that means you kind of, I mean, if you're going to pick a founder to invest in, then you definitely have to pick a founder that's going to listen to your therapy, right? You're also investing at really early stages where almost all you're betting on is the founder. So
yeah, and the market.
Yeah, founder and market, but I guess more founder than market, right?
You can say that.
Okay, so
I have interesting thoughts on that, but yeah, I do agree with you.
Okay, I want to hear those thoughts.
It's common knowledge.
Yeah, I want to hear your thoughts on that.
No, just I don't want to take us out of scope, but how we invest here, I know it's common knowledge that you're investing in the founder, right? But sometimes brilliant people are focusing on suboptimal problems to solve. Right? And so if you identify that sometimes a founder might be picking a suboptimal problem to solve, you might say you're really brilliant. You're very, very brilliant. But this mountain reduces your chances of being able to be successful. Right?
Yeah.
Sometimes you've seen brilliant founders, they have great experience, and they come out and want to build something for the African continent that you probably need disposable income of $1,000 a month to afford. It can be a lovely product. They would execute brilliantly. But as an investor, you have to look sometimes outside the founder. So I've seen your muscles. I've seen what you can do. Let me go and look at your opponent. Right? So even if you're a brilliant boxer and I see that you're trying to fight Anthony Joshua, I might say, you know what? Why don't we look for your weight class? Right? Or this thing is just too big. And so sometimes we step back from brilliant founders just because we think the market is not there, or the headwinds that are coming are just maybe too strong, or it's just not the right time. I'm sure you know a lot of very, very strong founders. We're trying to build 10 companies in the 90s in Nigeria. We didn't even have GSM. Yeah. So it was just a lot, right? OGs like Paga, if they had come at this time, you would have had probably a $10 billion company, right? But it was just, it came at the time, even though they were still successful, it came out at a time where building a company like that was much, 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 much more difficult. And so that's why, as much as we look at the founder, we look at
the problem,
the market, and what the future might be looking like in our own opinion, right?
Yeah.
So, but it has to be a brilliant founder, but that's not the only thing we look at.
Okay, I mean, fair enough, because ultimately, if you could be very brilliant, but the market is where you're playing, and it could always humble you. So
Correct.
I'm curious, when you're trying to like tell founders, okay, you're brilliant, you have a great solution, but the market is not exactly there. How do founders typically react, and what does that tell you about the founder?
So, it's a tricky question because, first of all, you have to understand that people are human, right? And we have emotions.
Yeah.
And those emotions, sometimes they make us make suboptimal decisions, but they're also the reason why it's what makes us tick, right? And I also think that if you're totally rational in life, you might not make it as a founder. You need just a little sprinkle of delusion to make it as a founder. No, you do, right?
Yeah.
You need a little sprinkle of delusion. And so just keep that aside, what I just said. And the reason why I said that is because sometimes people have put sweat and blood into building something.
Mm.
They are sensitive when you give them feedback. And that's why one of the big areas of our training programs for new analysts here is how to give founders feedback. In fact, if you became an analyst or a senior analyst at Oui Capital today, for the first 3 to 6 months, every time you're sending out feedback to a founder, especially to say no, or maybe Christine or somebody else who's senior on the team looks at all those rejection emails before we say, this is okay, send it out. Right? Apart from the fact that our reputation is our business stock, is the fact that we need to make sure we're not putting any toxicity into the entrepreneurial ecosystem. And so, as I always say, do not leave any space for an argument, right? Make it obvious that this is our own perception, and everybody knows that investors are wrong most of the time. Great investors need to just be right more often than the rest. Right? And so when we give that feedback, we say, this is our own opinion. We might be wrong. Not, you don't have this, or this cannot work. We'll say, we would like to see more of this if it will work. Right? And always, we never shut the door. So we leave the door open. And that kind of allows a founder to understand, okay, this is not for this fund, but it doesn't tell you that, oh, what you're doing is useless, or you should stop. Right? And sometimes we might put some feedback that is obvious. Right, that maybe you should reduce your burn.
Okay.
Right, so that you can stay alive enough to find product market fit. So things like that happen, but I think empathy is the greatest thing you need to put in there. Put yourself in the shoes of the founder. Even though this thing makes sense, do I want to hear it right now? Because human beings, we're emotional beings. And so sometimes, if you don't do that right, you get a reaction from the founder that you were not expecting. Of course, that person is not a robot, right? And so sometimes you have to deal with that.
Yeah.
But when you make your responses subjective, it allows the founder to say, well, that's your opinion, right? I'm going to keep grinding. And so that's really how the feedback usually is. And so it doesn't change my impression about a founder a lot of times if they react slightly emotionally to feedback, unless you just go crazy, right? And if you go crazy, I'm not the one to judge. It's other people who want to invest in you that will be like, do I want to deal with this person, right? And so that's another thing. Just managing your emotions when you're in tough times, it's also a skill.
So following up on that, from the founders, successful founders you've either invested in or interacted with, what would you say are like common qualities that they all possess?
They take feedback well.
Okay.
Right. They take feedback well. And taking feedback well comes with a level of introspection. Just after you've heard that and your emotions have kind of quelled, is what this person is saying true? Right? And can it help my business? Sometimes you never go back to that investor because how they delivered the message, you just don't want to work with them. But even a broken clock is right twice a day. So you'd be like, this person who I'm never going to work with, who I think hasn't treated me well, is there any truth in what they're saying? Right? Even me as a fund manager, it really did help me to evolve my pitch to LPs, right? I got some feedback and I'd be like, first thing in your mind, you want to think, oh, because I'm not white, right? Or, oh, because I didn't go to HBS. But then you go back and the person is telling you, hey, this market you're going into, doesn't it have some political instability? And you're like, that makes sense. How can I do this? Right? Can I fix this? Can I use some sort of diversification tool? Or should I leave this market alone for a little bit? Or someone tells you the fund you're trying to raise is too big or too small. And you take it personally. You think it's an attack on your person. Yeah. But sometimes they're actually seeing things that you're not. Right? And so I guess it's a very important thing of how you take feedback. The second one is that they continuously learn. No one comes into an entrepreneurial endeavor with everything they need, right? And the fact that you are probably the most qualified to go into that business amongst everybody else doesn't mean you are ready. It just means your starting point is ahead of everybody else, or you're starting from a good starting point. So when you even start, what then happens from then on? Right? Yeah. This happens for founders, this happens for investors, right? Do you start to upskill yourself from there? Because there are different skills you need to be a good engineer, there are different skills you need to be a head of engineering, there are different skills you need to be a CTO, there's different skills you need to be a CEO, yeah. Right? And there are different skills you need to be a founder. Sometimes you need to transition from being a founder into a CEO, right? And so if you just take your skill and behavioral stack and you think it's going to last you through the phases of developing your company, you might have challenges. And so a lot of the good founders I've met, when you meet them in year one, they're not the same person you meet in year three, right? Some of their beliefs have evolved, the way they handle things, the way they handle people. They've dropped some skills for other people to pick up, and they've picked up new ones, and you just have to constantly evolve. If I were to pick two, those are probably the first two on my mind.
Okay, ability to take feedback very well and then constantly learning. So when you're evaluating pitches at Oui Capital, what are some criteria that a founder should should try to meet if they are going to send a deck to you?
So early stage investing, and this is probably why I'm never going to do late stage investing, right? Early stage investing is science and art. And that's why when we hire for early stage investors, we look for people who understand the basics or who have strong opinions of their own, because you need to bring your art, right? Strong opinions of their own. And so when it's time to do deals, they can stick their necks out and just say, yes, it doesn't look like it, but this is where I think the market is going, right? Some you might be able to find data to back it up. Some is anecdotal evidence. Some is proxies. This is what predicting the future looks like, right? And so a lot of times you have to first understand that half of it is not things we can put into paper. The remaining half is all the good stuff that every investor says every time they get a mic, right? Do they have a strong team? Is the market big enough? That's actually very important. Again, as I went back to say, there are a lot of brilliant fishes in terms of founders or entrepreneurs swimming in aquariums. It's just, that's how big you can get if you're going to grow in an aquarium, right? So first you have to make sure you're in a big ocean. First thing, if you fail, that's fine. But if you wanted to succeed, there won't be a limiting market, right? So the founder, the market, and when it comes to teams, we look into the chemistry, because we realize one of the leading causes of failure is the fact that teams break up, right? So you want to figure out what's the chemistry in this team, not just by looking at them. It's like, do they have bonds? For example, I and my co-founder, this is our second company together. The first one was an internet company that never made it, but it builds a bond. You know what I mean?
Yeah.
It builds a bond that I won't say is unbreakable, but is very strong, right? And we were classmates in business school. So it builds a bond. We do know how to sort out our differences without a therapist, right? But sometimes when the chemistry is not that strong, and sometimes the chemistry can just be the why, right?
Okay.
You had a close family member die of cancer. I had a close family member die of cancer. Let's build a diagnostic tool that can detect cancer early, right? So you see that these guys have a why that brings them together, strong. So we do look at that when it comes to team chemistry. And also, do they have complementary skills, right? I think, just like for fund managers, there's some fund managers that can sell, right? They can sell. But if you put a balance sheet in front of them, they can't read it, right? And there's some fund managers, they're amazing at financial modeling, doing all that stuff, market analysis, but they can't raise money. Or they can convince a founder to let them in a round, right? And so these are complementary skills. And what usually happens is, for successful fund managers, is that one person has both, or they're two people, and it's like yin and yang, which you would notice in a lot of partnerships, fund partnerships around the world. Same thing with founders. You will notice that a lot of successful companies, there's one founder you know, and there's another founder who probably has just as much equity that you don't know about, right?
Yeah.
Because they usually complement in each other. And so we look out for that in teams too, to just find out, is there a nice balance of competencies here? The third thing we'll probably just look at is all the other things that are outside your control. What's regulation looking like? What's the future looking like? What's FX looking like? What's competition looking like? Right? Is Netflix or Facebook interested in this thing? If it is,
maybe not.
Yeah, right? You're going to have to start with at least 200 million. So I think those are some important things. But also there's a lot of material on our website and our YouTube channel that talks about things that span hours on how we invest. I think TechAbal actually just wrote an article on how we look at investing. That's also a useful article, link below, to look at and figure out, how does these guys invest? But usually those are the things. And then the rest is art.
Okay. So speaking of strong opinions, what are some that you hold about investing in Africa or building a startup in Africa?
Where you went to school doesn't matter.
Okay.
I don't care. Right. The investors pattern match. There was there's a company we invested in called Moniepoint, which is now a household name, called Teamapt at the time. And I did introduce, I think they were raising at a really, really small valuation, probably less than 15 million at the time. And I did introduce them to a fund manager. And I said, hey, these guys, they have one of the strongest engineering teams I know. And I think just looking at what is out there, I think they probably are going to have the lowest transaction failure rate in the market, right? Just based on what their precedence has been, right? And I said, look at this founder, super, super, super frugal. All the makings of a great founder. And this fund manager responded to me. His first question is like, oh, so where did he go to school? And immediately I just said, okay, you're probably the 80% that shouldn't be investing, right? Because entrepreneurship or venture capital is about finding, especially early stage, it's about finding entrepreneurial ingenuity, right? And so that's the one thing, right? Once I see the pattern matching, saw this company on TechCrunch, this guy is part of this fellowship, it's not like we go against it. It's great, right? But I think it doesn't matter. Look at the profile of some of the successful companies. They don't look like the people that VCs run after every day. So why aren't we learning from it? That this thing doesn't matter, right? People went to Babcock, OAU, and then every other day you're hearing that the guy who went to Harvard and Stanford has defrauded investors, right? And so I don't understand, right? If someone understands the problem they're building, they're knowledgeable enough about the problem, look like they have complementary skills, we will back them.
Okay.
Right. So that's one of my own takes. So once I hear it, I just switch off. I just switch off.
Okay. Any other one?
We're not 200 million people.
Okay.
Right?
Okay.
You see on DEX, market of 200 million people.
Yeah.
We're not 200 million people. We're enough to build a unicorn. Right? But we're not 200 million people. And when I say we're not 200 million people, I mean just because of the per capita income of a lot of African countries, you probably have to discount what the market looks like, except you're selling a really cheap product, which is now the winner, right? But for most things, when you say 200 million people, you probably have to start from 100 million in Nigeria, which is still a big market, right?
Yeah.
But when you see market sizing that sometimes doesn't really reflect what the reality on the ground is. I think I did just read an interesting piece by Dr. Ola Brown, maybe 2-3 years ago, when she talked a little bit about it. I'm sure she held those opinions strongly, but to an extent, I do agree, right? That market size shenanigans, it's great on paper, or when you're sending it to someone who sits in San Francisco. But for local investors, I think we need to look at the market as a little more dynamic, depending on the product you're trying to sell.
Okay. I mean, I think I read the article, and there have been some, let's say, revelations in the last few weeks. Number of people who have an NIN in Nigeria, and I think NIMSI says nearly 70% of us have NIN, and that makes me think, okay, maybe the 200 million we had is ridiculously exaggerated. We are probably closer to 120 million than 200 million. So yeah, that makes sense. So I guess it's really important for founders to note that when they are sizing the market. So I was going to ask you, what are some things you see in a founder, and then you're like, this guy will make me suffer. But I think you've kind of answered that a bit. I don't know if you have any other trait.
When you say this guy will make me suffer,
like
what do you
founder,
mean?
like you just know that if I invest in this founder, okay, so why I ask is that I think it was Kola that said every single time he has gone ahead to back a brilliant founder who was a shitty person, that he has regretted it. So I was like, okay, what are some traits that you saw in the founder? Like, if I invest in this guy, I'm going to pay for it.
I actually have a very unique standpoint on this.
Okay.
It's against my personality, but it is just what it is, right? I do agree, especially those two things that I said. If a founder feels like they know everything they need to be successful already, so that means they're not in that growth mindset. They're not in that upskilling mindset.
Yeah.
It might be a problem. The second thing is that if a founder doesn't take feedback well, right, there might be a problem. The company might fail. But there's the 10% jerk rule, right? Where, and this is not me, but for example, guys like Travis Kalanick, where people think, he's very different from the traditional, takes feedback, founder, you know what I mean?
Yeah.
Or even Elon, right? And so, but you would have been a damn smart investor if you had invested in Uber, right?
Yeah.
Even if sometimes he would tell you to F off with your money. You're just like, sometimes you need to just do the jerk rule and say, you're telling me to F off, but just keep the money, right? Sometimes people, and though this is not thesis, right? And this is the 50% of art.
Yeah.
I've had founders who were coming from some place of trauma. And so the way they react to investors, because they're humans, is kind of weird. Because they do have some trauma from dealing with some sorts of people. And so you're wondering, why is this guy antagonizing me from the beginning? This guy is a jerk, right? But when you dig deeper, you realize that they are a nice cat pretending to be a tiger just because they've probably been hurt, right? And so this is where your intuition as an investor comes in. Sometimes, and then when they roar at you, you roll back, but you don't take your money back. You say, keep this money. That anger, that passion is going to help you build me a successful company, right? But again, it's not thesis you teach a junior analyst, right? It's just sometimes it comes to you, your gut feeling. So I would say 90% of the time, if someone is shitty, they would probably not be a successful entrepreneur. But keep that 10% and follow your gut.
All right. So I think 2021, you invested in Team Ups. Was it before then?
I think it was 2020.
2020, okay.
Yeah.
You invested in Team Ups.
It's beginning to, the world is full.
Yeah, and just a couple years down the line, Tosin turns around to be one of your LPs in a new fund. How does that make you feel?
Can you imagine? It's. I feel like I got my full circle moment quicker than expected, right? The life cycle of a fund is usually around 10 years. And it usually takes closer to that kind of time for things like this to happen, right?
Yeah.
A founder you invested in becomes your investor, right? So they send you updates, you send them updates, right? But it's just one of the joys of, this is why I do venture, right? This is why I moved back home, to be able to create memories like this for myself and for the team, right? You can't buy it.
Yeah.
And so it's a feedback loop that has closed, right? To say you're doing something right. And so, by the way, he's not the only founder we backed that is an LP.
Okay.
I'll give you that one in exclusive. But yes, it does happen, and it's just a moment for you to see the real result of the kind of value that you and your team are creating, right? Who knows? Probably bigger LP in our next fund, right? But it's so rewarding that I can't put it into words. It's just like, wow, right? And it came barely 5 years. We're in the 6th year now of our fund. So barely in 5 years. And it's a very humbling experience. Shout out to Tosin.
Yeah, shout out to Tosin. Okay, so we have these conversations occasionally about how VC is probably not the best vehicle for investment in Africa. I mean, quite a lot of people have their own thoughts on it. Although I can't say I've seen anyone who has expressed really detailed reasons why they think VC is not the best. What's your take on that? Do you think that venture capital, as it is currently, is a great vehicle or is the best vehicle for investing in African startups?
Short answer is still yes.
Okay.
The problem is, VC is it's a viable option, funding option in the entrepreneurial or capital universe. The problem is you want to use VC for everything, right? VC has specific types of business models that it was created to back. And VC is not an all-in-one silver bullet for funding. VC starts to fail when you apply it to businesses it has no business backing. This is the problem, right? Venture capital, from the name venture, is created to back high risk, high reward businesses, right? The problem is they also want to use venture capital, especially in the early stages, to back low risk, low reward businesses, or high risk, low reward businesses, which is one I see most often, right? You tell me, oh, okay, it's high risk, but you tell me, oh, you can make 5x. That's not enough reward for how much risk I'm taking. Or you can make 2x. But that's money. I mean, yeah, but it's not meant for venture capital, right? You should go to a bank, an angel, a private equity firm, or a finance house for that kind of money, because they have tapered down IRR targets based on the risk. So when you want to apply VC to non-high risk, high reward, and when I say high reward, I mean high reward businesses, then VC starts to fail because it's not created for that, right? It's like using malaria medicine for cancer. Doesn't mean the drug is not good. No, but that's not what it was created for. And so when you see VCs or people, we get all sorts of pitches. And sometimes you have to be nice and just say, you know what, this is not in the reward profile we're looking for, right? And this is why we back tech businesses mostly, because tech businesses can grow at a pace where traditional businesses, where you have a fiscal element to serve people, doesn't exist, right? For example, this podcast can go from 1,000 people today to 1 million people today, right? YouTube has the infrastructure to handle that. Can you grow your logistics business or your restaurant business or your coffee business, right? Or your furniture business from one customer to 100,000 customers in a month or two? You can't, right? Yeah. It's low risk. You will probably sell your furniture, but that's not what venture capital was created for. And so I think VC just sticking to the kind of businesses it was created for is great on the continent, right? The misuse of, or attempted misuse of VC money is where the problem is.
Okay, I think that's a good solution on that topic. So you have like two major stakeholders now. You have the founders you back or hope to back. Then you have your LPs. For the LPs, you need to return capital or you probably wouldn't raise a fund.
Correct.
But in order to do that, you also have to invest in really promising startups.
Correct.
How do you negotiate the tension or balance between these two responsibilities?
I think the responsibility is, first of all, you have to take a step back. And I think it's a misconception about VC. You are more of a finance bro than a tech bro, right? Okay. As a VC. You can wear your nice vest still, but you're more of a finance bro. And that's why if you don't understand money management, you might be successful as an angel, but maybe not as a VC, right? Because eventually it's money management business. You're a fund manager, regulated by SEC. And so the knowledge of that goes into building your portfolio and your risk model. You have to take it into consideration of that. Yes, I expect there to be these amount of failures, right? But with the way I'm investing, also these types of outcomes, and they have to balance out in a way where you not only return money to your LPs, you make some money for yourself and for your team, right? Because this is why we do it, to do good and do well for ourselves. If not, everyone who works here today shouldn't be here. They should just work at some bank, right? And so what it is giving you LP money, because it's a blind pool, is a very, very high level of trust. And so that trust factor already insulates you because it's a blind pool. LPs don't tell you who to invest in, when to invest, how much to invest, or when to exit, right? They can't tell you that. The paperwork ties their hands to trust you. And so once you can insulate that and gain their trust, you now have to block out the noise and really figure out, how do I make the most of the money that I've been given as a fiduciary of people's trust, right? And incentives are aligned. If your LPs don't make money, you don't make money as a fund manager, right? And so you can even be selfish. Think about yourself. How do I make money? If you make money, your LPs are going to make money. And so that trust is the first insulation. Then you can now go further and look at what's my risk appetite. And you have to build a solid portfolio model. How are we going to invest? It's not vibes, right? And you have to stick to it as much as possible. You might have to go back 1 year after the other to tweak it. Or the market is hot now, valuations are high. I might not be able to get the stakes I wanted to get before. What do I fix in these things, right? For example, for our first fund, we did over 20 investments. For our second fund, we're doing probably somewhere around 15, even though we're writing much larger check sizes. This is a result of sitting down, brooding, and figuring out what works in the market now, right? And we've decided to go a little more concentrated, a little more higher stakes, a little more support, a little more all in. So it just depends. But I think portfolio construction is the secret to being able to follow a plan and return money to your LPs.
Okay. So earlier you were sharing that you've done one investment in Guinea-Conakry, which is like, I don't know, probably half of Nigerians, or even more than that.
Half?
Okay. Most Nigerians do not know
that
there's a Guinea-Conakry. Mm-hmm. How, apart from the usual 4 countries that gets all the money, what are some countries that you're looking at and like, we should start doing something around these countries?
So we don't really look at it that way, except the macros of a country are just so strong. And you just see an explosion of founders, or something has changed around regulations that now makes it hot, right?
Yeah.
We don't usually take that country approach. For example, some regulations are about to change in Morocco, right? Around what, around cash in, cash out, and what IMTOs and just money transfer companies can do, right? It's going to take some power from the banks. That's about to open up. Then we can look where the opportunity is there. But outside things like that, we don't just look at a country and say, oh, because sometimes it's, how do they say, it's diamond in the rough, right? Sometimes it's when things are going bad in a country that a great company can pop up because it's a new problem. And so we look at case by case, company by company, and we take a fresh set of eyes and just look what's happening in this country at this time, right? Does it fit the time in for what she's building or he's building in this place? And so it's not common that we just look at those places. What happens is that for a lot of funds and investors is Nigeria ends up being a chunk of your portfolio because truthfully, it's one of the biggest markets and probably has some of the highest amounts of deal flow. So the deal flow now mirrors what the portfolio looks like. That being said, we have investments in countries like Mauritius, Zimbabwe, Guinea, Conakry, if I remember. But of course, we have the usual suspects to Egypt, Nigeria, Senegal, Kenya. But yeah, we do look at markets. We do look at companies. We get stuff from companies. We have a whole website in French. Right? So we do see stuff. And when we see stuff, we analyze it case by case basis at every point in time. So there's no one country that I would say, oh, it's hot. What you get a lot of times with development finance institutions is they want you to go invest in a particular country. That becomes tricky because it means that even if they aren't great deals in a country at that time, you just still do it. And then at that point, it's almost choosing between your strategic objectives and returning money to your LPs. So sometimes that gets tricky. But at the fund, all of our capital is commercial capital. So we're chasing the gold.
All right. Okay, so I think we've come to the end of this. Thank you for a very interesting conversation.